Are you absolutely tired of guessing exactly where a market pullback is finally going to end? Well, today we are diving into advanced Fibonacci retracement strategies for swing trades. This is exactly how the pros stop guessing and start executing. So let's get right to it.
Seriously, stop guessing where the dip ends. If you want to stop getting stopped out and start pinpointing those high probability entries in US equity markets like a true professional, you've got to master this strategy. We're going to take you from being a reactive trader and turn you into a proactive one.
Part 1. The core Fibonacci concepts, the foundation of the strategy. So, Fibonacci retracement is our absolute go-to tool for identifying potential support and resistance zones during market pullbacks. Now, it's actually based on this mathematical sequence discovered way back in the 13th century, but listen, here is the most important thing you need to grasp right out of the gate. Institutional traders, they do not use this as some magic crystal ball or predictive indicator. Nope, they use it as a probability matrix. As swing traders, we use it to estimate high probability entry zones right after a clear trend has been established. It is all about stocking the odds in your favor. Part 2. Drawing and level interpretation. Mapping exact zones. Okay, let's dive into this. To set this up perfectly, you always want to draw the Fibonacci tool from a clear swing low to a swing high in an uptrend, or obviously from a swing high to a swing low in a downtrend. But the real secret here is understanding what each specific level actually tells us about market psychology. For instance, a 23.6% pullback, that signals an aggressively strong trend. Then the 38.2% is your standard healthy retracement. After that, you've got the 50% mark, which is just a super common reaction zone. Down at 61.8% is the famous golden ratio. This is a massive decision area where institutions love to step in. And finally, the 78.6% is a deep retracement, kind of like the last line of defense before a total trend reversal. Just remember, guys, experienced traders view these as zones, not exact to the penny prices. Part 3. Indicator confluence and confirmation. Wait for confirmation.
Now, advanced traders don't just trade these levels in isolation. No way. They stack indicators to build a totally bulletproof case. You really want to combine your retracement levels with moving averages like the 20, 50, and 200 EMA or SMA. Or look for confluence with trend lines and those heavy nodes on the volume profile. I mean, if you're looking at a chart of Apple or the SPY, you don't just blindly buy the golden ratio. You wait for candlestick confirmation. Think hammers, bullish engulfing candles, or shooting stars. And you absolutely must confirm momentum using the RSI or MACD. Let me be clear, trading a standalone Fibonacci level without these confirmations, that is a massive trap.
If you're enjoying this breakdown and want more professional U.S. stock market strategies every week, make sure to like this video, share it with fellow investors, and subscribe to Fox of Wall Street so you never miss an opportunity. Part 4. The swing trading workflow. Step-by-step execution. All right, so here is your systematic workflow. First up, establish a clear market direction. Then draw your Fibonacci from swing point to swing point. Now comes the really hard part, waiting patiently for the pullback into your high probability zone. Once it actually hits, confirm that momentum using your RSI or MACD and look for that specific price action trigger. And for profit targets, you can look to previous highs or use Fibonacci extensions like the 127.2% and 161.8% levels. In high momentum US stocks like, say, Nvidia or Microsoft, these extensions are absolutely phenomenal for capturing that next leg up in price discovery. Part 5. Risk management. Protect your capital. Listen closely, because this is the unbreakable golden rule. You must risk no more than 1 to 2% of your total trading capital per trade, period. When you enter a Fibonacci setup, your stop loss has to be placed safely outside the retracement zone. That means either below or above the next major support or resistance level. You have to give the trade room to breathe without exposing your entire account to ruin. Honestly, this right here is the main dividing line between winning and losing traders. A professional trade setup demands a minimum 2-to-1 reward to risk ratio. The classic amateur mistake, entering a trade solely because the price magically touched a Fibonacci line without any calculation of risk or reward. You literally must demand that your potential profit is at least twice the size of your potential loss before you even think about risking a single dollar. Part 6. Common mistakes to avoid. Avoid these pitfalls. Let's run through your ultimate performance killers so you can actually protect your capital. First up, using Fibonacci in sideways or choppy markets. Guys, this is a trending tool. It fails miserably in consolidation.
Second, drawing from incorrect or minor swing points instead of major structural highs and lows. Third, completely ignoring earnings events. Never, ever hold a pure technical swing trade blindly through an earnings report, because macro events and institutional volume are always going to override technical levels. And finally, entering without candlestick confirmation. You need absolute patience here. Let the market prove it wants to bounce before you commit.
Ultimately, Fibonacci retracements prove that the markets aren't just random chaos. They actually move to a psychological rhythm that you can measure. I mean, the math is ancient, but the human greed and fear behind it, that happens every single day. So what is your favorite technical indicator to pair with Fibonacci to find your edge? Let us know down in the comments. Thanks for watching Fox of Wall Street. See you in the next market breakdown.